So there's a big dilemma investors are facing right now. Imagine you are at an auction and the bidding for a special painting just hit a record high. Would you jump in now or wait for the next auction hoping for a better deal? That's exactly the dilemma investors face today with the stock market at all-time highs. The S&P 500 is hovering around 5500, up nearly 25% from last year. The Shiller PE ratio, a measure of market valuation, is sitting at about 35. That's almost double the historical average. It's enough to make any investor's palms sweat. So you're probably thinking, shouldn't I wait for a dip before putting in all my money? It's a natural thought. After all, we are taught to buy low and sell high, right? And history shows us plenty of examples where markets stumbled after reaching new peaks. Just think about the dot-com bubble in 2000 or the financial crisis in 2008. Investors who bought at those peaks had to wait years to break even. So it seems safer to wait, doesn't it? Wait for the inevitable correction and then swoop in and buy stocks at a discount, right? It feels logical and it feels like the smart move. But here is where things get interesting. Back in 1997, as the stock market was forming into one of its biggest ever bubbles, Jack Bogle, the founder of Vanguard and godfather of index investing, gave a speech on investing during overvalued markets. Listen to what he said.
In short, it seems to me that speculation, betting on higher and higher valuations, is in the driver's seat. Investment, betting on the fundamentals of dividend yields and earnings growth, is in the back seat, probably even in the rumble seat. But when speculation drives stock returns in the short run, while it drives stock returns in the short run, it's the crystal clear lesson of history, at least the past 200 years, that in the long run, fundamentals drive returns.
But wait, is this speech really from 1997? It's kind of crazy how spot on Bogle was, right? I mean, he could be talking about today's markets, right? It's almost spooky how similar things are now that he described back then. But Bogle didn't stop there. He laid out two possible scenarios.
Let me give you two extreme possibilities. One, a market drop of 35%, just for the fun of it. This would lower price-earnings ratio to a more ratios to a more normal level of about 13 times. And at 5,200 in the Dow, we would still repose, I might add, fat, dumb, and happy, where we sat in January 1996, just a year and one half ago. This is hardly a doomsday scenario. Two, we're in a new era in which stock returns average 15%. In short, a new era of boom times and high valuations that would justify today's price levels. Now, of course, it could happen, but I wouldn't bet the ranch on it. The U.S. stock market, however, seems to be betting the ranch on it. It's priced, I think, for the best of times and only for the best of times.
So that sounds familiar, right? We are facing the same dilemma today. Is this a new era of unbelievable growth or are we due for a big drop? So what did Bogle advise in such uncertain times? His wisdom was simple yet powerful.
I don't know anybody who has ever been successful in timing the market. I don't even know anybody who knows anybody who has ever been successful in timing the market.
So pretty strong words from a guy who revolutionized investing, right? But why does Bogle say this? It comes down to a simple but powerful concept: consistency. So let me share a personal story. Back in 2008, I was new to investing. The market was crashing and I thought, this is it. This is the perfect time to buy, right? So I invested all my money back then. But guess what? The market kept falling. I felt sick to my stomach watching my investment shrink day by day. But the asset managers keep on telling me to put in more money. And that's when I learned about dollar cost averaging, and it changed everything for me. So think of dollar cost averaging like filling a swimming pool. But here's the twist. The price of water changes every day. And there's the catch. It tends to become more expensive over time. Some days water is costly and you get less for your money. Other days it's cheaper. And now you might think, Why not just wait and buy all the water on the cheapest day, right? But here's the problem. You never know if today's expensive water might actually be a bargain compared to the future prices. In fact, historically, water prices like the stock market have increased about 75% of the time. So while you might catch some bargains by waiting, you could also miss out on a lot of swimming or returns in the meantime. And that's why dollar cost averaging is so powerful. So it's a fancy term for a simple idea. Invest a fixed amount regularly regardless of market conditions. When the market is high, your money buys fewer shares, like getting less water on expensive days. And when it dips, you get more shares for your money, like filling up more when water is cheap. This way, you are not trying to outsmart the market. You are in the pool consistently enjoying the benefits while your average cost evens out over time. Plus, you are not risking missing out on the long-term upward trends by waiting on the sidelines for the perfect moment to jump in the pool. Over time, this approach can lower your average cost per share, and that's the goal. But here's the kicker. This strategy removes the pressure of trying to time the market. You're not trying to guess the peaks and the dips, you are simply showing up month after month, allowing the ups and the downs to average out over time. But I know what you are thinking. That's all well and good, but what about those major crashes? And that's a fair question. Let's look at some surprising historical data. Did you know, for example, that if you had invested at the absolute worst time before the 2008 financial crisis, literally the market peak, and then continued investing monthly, you would still have doubled your money by 2021. Yes, that's right. Even with the worst timing imaginable, consistency won out. In fact, a study by Schwab looked at 5 hypothetical investors who each invested $2,000 per year into the S&P 500 starting at different market peaks. Despite starting at the worst possible time, after 20 years, each investor saw their $40,000 investment grow to an average of $80,000. Only Larry didn't do well. He left his money in cash investments using treasury bills as a proxy every year and never got around to investing in stocks at all. He was always convinced that lower stock prices and therefore better opportunities to invest his money were just around the corner. And here's another mind-blowing stat. Despite all the crashes, the wars and the recessions, the S&P 500 had provided an average annual return of about 10% over the long term. At this rate, it's possible to double your money approximately every 7 years thanks to compound growth. So the lesson here, today's all-time high might be tomorrow's bargain. So ask yourself, in 10, 20 or 30 years, will you regret buying at today's high prices? Now, I'm not saying it's easy. Investing when the market seems overvalued can be nerve-wracking. And that's why it's crucial to have a personalized investment plan that aligns with your risk tolerance, your time horizon, and financial goals. This plan acts as your North Star, guiding your decisions regardless of market conditions. So while it might feel counterintuitive, consistently investing even at market highs has historically been a winning strategy. Remember, it's not about timing the market, it's about time in the market. But this brings us to another important question. What exactly should you be investing in during these uncertain times? In our next video, we will explore the ETFs that could thrive in any market condition, giving you the tools to build a robust all-weather portfolio. So don't miss out. Until then, keep investing, stay consistent, and remember, the best time to invest was yesterday. And the second best time is today.